Right now, the biggest bottleneck in artificial intelligence isn't the software algorithms.
No, and it isn't even the silicon chips themselves either.
Right. It is the literal plumbing required to pump electricity into those chips without melting the entire system down.
Exactly.
So today, we are looking at a company that claims to have completely redesigned that plumbing, and we are unpacking the financial fallout of that claim,
Welcome to a brand new deep dive. Today, we are digging into Vicor Corporation's Q2 2026 earnings report.
which covers the period that ended June 30th, 2026. And this is all pulled directly from Vicor's official July 21st news release, their condensed consolidated financial statements, and some unusually blunt commentary from their CEO.
Yeah, that commentary is something else. But, the mission for you listening today is to really decode the story playing out beneath the headline numbers.
Because it is incredibly easy to just glance at a single revenue line, assume you know the trajectory of a business, and then just move on.
Right. But today, we're looking at how a seemingly flat revenue print is actually hiding an astronomical spike in backlog.
And a rapidly shifting business model. Plus, this fascinating solution to the physical power bottlenecks that are literally crippling the next generation of AI hardware.
Yeah. So whether you're tracking the high-performance computing supply chain or looking for the physical limits of the AI boom.
Or if you just want to see the financial blueprint of a company flexing a massive technological advantage, this report is the map.
Absolutely.
So we have to start with the top-line growth to establish exactly where Vicor stands today. Because honestly, doing a direct year-over-year comparison here requires a magnifying glass.
It really does. So for Q2 2026, Vicor reported total net revenues of $143.4 million.
And sequentially, if you compare that to Q1 2026, which sat at $113 million, that is a massive 26.9% jump in a single quarter.
Right. But the headline trap catches you when you look back a year. If you compare that $143.4 million to Q2 of 2025, well, revenue back then was $141 million.
Yeah, so on the surface, the company looks totally stagnant.
Exactly. You're looking at a difference of just a couple of $1 million over 12 months in an industry that is supposedly booming.
But that $141 million from last year was carrying a very heavy asterisk.
A huge one. It included a $45 million patent litigation settlement.
Right. That was a one-time influx of legal cash.
Yeah.
It was not ongoing operational revenue from selling components or licensing tech.
And if you only look at the top line year over year, you completely mask the actual operational growth happening right now.
Because if you strip out that $45 million legal windfall, the core business is actually scaling at a blistering pace.
Oh, 100%. When you break down the $143.4 million in total net revenue for this recent quarter, you really see the true operational engine.
Right.
Product revenue came in at $112.9 million, and royalty revenue hit $30.4 million.
And that combination is dropping straight to the bottom line, right?
Yeah.
Net income for Q2 hit $49.8 million, or $1.04 per diluted share.
Yeah. And just to contextualize that profitability scale, in Q1 of this year, net income was just $20.7 million, or 44 cents per share.
Wow. So they more than doubled their net income in 3 months.
They did.
I want to focus on that $30.4 million royalty revenue figure for a second, because that isn't physical power components going out the loading dock.
No, it's not.
We know Vicor successfully defended its patents last year, which resulted in that $45 million settlement. But how does a company pivot from winning a defensive legal battle to generating a $30 million recurring royalty stream in a single quarter?
Well, it represents a fundamental shift in their margin profile and really their market positioning.
Okay, how so?
Winning that settlement didn't just put cash in the bank. It established a legal precedent. It proved their intellectual property regarding power delivery architecture is both entirely unique and legally unassailable.
Ah, I see.
So what you are seeing with that $30.4 million is the active monetization of that precedent. Competitors and partners building high-performance compute systems are realizing they physically cannot bypass Vicor's patented architectures.
Because they need to achieve specific power metrics.
Exactly, so they have to pay the toll. Vicor is no longer just a manufacturer constrained by the physical limits of their assembly line and raw material sourcing.
Right, they've layered on a high-margin recurring revenue stream that's scaled infinitely without requiring them to build a single additional physical component.
Yes. They essentially established a toll booth on the busiest technological highway on the planet.
That is wild. It shifts the valuation model from a pure hardware play to like an architectural licensing hybrid.
It really does.
So that $30 million royalty stream proves the tech is necessary. But to see if the broader market is actually adopting their physical products at scale, we need to look at what hasn't shipped yet.
Right, the backlog.
Yeah, and the backlog numbers here are staggering. At
Yeah.
the end of Q2, Vickers' backlog sat at $380 million.
Which is a massive indicator of future recognized revenue. That $380 million is a 26% sequential increase from Q1, where they had $301 million.
But look at the year-over-year comparison. In Q2 2025, their backlog was $155 million.
Yeah, that is a 145% increase in a single 12-month period.
Wait, a 145% jump in a single year sets off my alarm bells, honestly.
Oh, sure.
Given the wild swings we've seen in the tech supply chain over the last few years, like the massive semiconductor shortages followed by sudden gluts, how do we know this isn't just industry panic buying?
That's a fair question.
Like, are customers double or triple ordering just because they have supply chain anxiety, artificially inflating that 380 million figure?
Well, institutional analysts look for exactly that kind of ghost demand, which is usually called phantom backlog.
Right.
But two key factors in this report suggest this is structural, sticky demand rather than panic hoarding.
Okay, what's the first factor?
First is the breadth of the applications. CEO Dr. Patrizio Vinciarelli noted this rising demand is being absorbed across high-performance compute, automatic test equipment, industrial, aerospace, and defense applications.
Oh, so it is not just one overheated hyperscaler double ordering servers.
Exactly, it's across the board. Second is the nature of the architectural shift.
What do you mean by that?
When a hardware company designs a next-generation system utilizing Vicor's proprietary power delivery components, it is a hard integration.
Ah, meaning they cannot simply swap in a generic commodity part if Vickers lead times get too long.
Right. The design is locked in. The customers physically cannot build their next-generation products without these specific components, which makes those backlog orders incredibly secure.
So to visualize this, it's like a highly sought-after restaurant that isn't just fully booked for the night. They have a wait list of customers stretching into next year, waving non-refundable cash in their faces,
Yeah, that's exactly it.
prompting the owners to immediately start buying up the real estate next door to build more kitchen.
Right, because the CEO noted that this demand is completely absorbing the increased capacity within their first chippy fab, their fabrication facility.
Right, and because they're getting so close to full utilization, he explicitly stated they are already taking steps toward a second fab, specifically for their high current density second-gen VPD chips.
But, building a brand new semiconductor fabrication facility is one of the most capital-intensive projects a business can undertake.
Oh, absolutely. You cannot fund a new fab with backlog alone.
Yeah.
You need massive amounts of liquid capital.
Right. So to see how Vicor is actually funding this rapid manufacturing expansion, you really have to look at the balance sheet.
And in Q2, they generated $34.0 million in cash flow from operations.
Which is a sharp rebound from Q1, where they actually reported a negative operating cash flow of $3.9 million.
But that negative Q1 number was also dragged down by legal history, right?
Yeah, there was a $28.6 million payment for an award from past litigation.
Okay, so once you strip away that one-time payment, the underlying operational engine generated $34 million in pure operating cash in 3 months.
Exactly. And that cash goes straight into a rapidly expanding war chest. As of June 30th, their cash and cash equivalents increased 12.2% sequentially.
Sitting at $453.6 million.
Yep. And their unit economics are improving simultaneously. Their gross margin as a percentage of revenue expanded to 58.0%, up from 55.2% in Q1.
Right, because when you combine higher margin physical products with pure margin royalty revenue, that cash pile accumulates incredibly fast.
It does, but the most revealing metric regarding their expansion strategy is their liability profile.
Oh, definitely.
Total assets stand at $894.1 million, but their total current liabilities, the short-term obligations they have to pay out, are remarkably low, sitting at just $50.5 million.
They could pay off all their current liabilities 9 times over just with the cash they have sitting in the bank today.
Easily.
And I want to point this out because when we usually hear about rapid hardware manufacturing expansion, the assumption is the company is taking on massive leverage.
Right, floating corporate bonds or taking out huge loans to fund the construction.
But sitting on $453.6 million in cash with minimal current liabilities, that fundamentally changes Vicor's strategic posture when deciding to break ground on a second fab, doesn't it?
It provides absolute strategic sovereignty.
Sovereignty. I like that.
Yeah. When a hardware manufacturer is highly leveraged, Their expansion timeline is completely dictated by external credit markets. If interest rates spike or the macroeconomy wobbles, securing the loans to finish a fab can become prohibitively expensive.
Or just impossible.
Right. But VICR is self-funding. This fortress-like balance sheet means they can expand their manufacturing capacity precisely when their $380 million backlog demands it.
Completely insulated from the cost of capital.
Exactly. Furthermore, it gives them immense leverage when negotiating with their own supply chain partners and tooling vendors. They are expanding from a position of cash-rich confidence, not desperate, debt-fueled speculation.
Okay, so we've established the fortress balance sheet, the expanding gross margins, and the skyrocketing backlog. But we need to answer the core underlying question.
Right. Why?
Exactly. Why is everyone across aerospace, defense, and particularly high-performance computing flocking to VICR right now?
Well, the CEO's commentary reveals that this surge in demand really comes down to the unforgiving physical constraints of modern computing.
Right.
Dr. Vinciarelli was exceptionally direct in his earnings commentary. He stated that AI OEMs and hyperscalers are, quote, at a loss, trying to deal with the current density and power delivery network, or PDN, limitations.
Wait, he literally said they are at a loss.
He did. They're struggling with the limitations of first-generation VPD systems. And when the CEO of a power component company publicly claims the titans of the AI industry are at a loss, it signals a massive architectural bottleneck.
Okay, so we know PDNs are the physical pathways in components that deliver electricity from the source to the actual silicon processors, like the GPUs training AI models.
Right.
Why are the current first-generation systems hitting a physical wall?
Well, the CEO mentioned the industry is currently fixated on a workaround involving point-of-load, or pull, regulators. Specifically, he said they're replacing voltage regulators, VRs, operating from 12 volts or 6 volts, with integrated voltage regulators, IVRs.
Operating from 1.8 volts.
Right. But he bluntly calls this workaround flawed because it merely trades one handicap low current density for another handicap, which is low current gain.
Okay, to understand why the hyperscalers are at a loss here, we really have to look at the physics of power delivery.
Exactly.
Artificial intelligence processors, massive GPUs, and wafer-scale engines require astronomical amounts of electrical current to crunch data.
We're talking hundreds of amps.
Right. However, to operate efficiently and prevent the silicon from degrading, they run at very low voltages, often well under a single volt.
And the fundamental rule of electrical engineering is that pushing massive current across any physical distance creates resistance.
Which manifests as heat.
Yes. This is known as I squared R loss. The more current you push and the further you push it across the motherboard, the more power you lose as pure heat before it even reaches the processor.
Which creates the physical bottleneck of current density. Because you can only cram so much current into a tiny physical space on the circuit board before the traces melt, or the system just loses all its efficiency to heat loss.
Exactly. So the industry's standard workaround has been to deliver power across the board at a higher voltage, like the 12-volt or 6-volt VRs the CEO mentioned.
Because higher voltage means lower current, which means less heat loss during transit.
Right. Then, right next to the processor, they try to step that voltage down. The current industry fixation is using those 1.8-volt integrated voltage regulators placed close to the load.
But Dr. Vinciarelli points out the fatal flaw in this logic, right?
Yeah, he says it trades low current density for low current gain. By dropping to 1.8 volts too early in the delivery path, you still have to push a massive amount of current that final distance to the chip.
And the regulators themselves can't handle it.
Nope. They cannot amplify or gain enough current efficiently in a small enough footprint. The physical space required to regulate that much power basically chokes off the processor.
Okay, to visualize what's happening with these IVRs, it's like trying to push a fire hose amount of water through a standard garden hose.
That's the perfect way to look at it.
And everyone else in the industry is just trying to change the shape of the nozzle to make it work, while the hose itself keeps bursting from the pressure. But VICR is showing up and offering to completely redesign the plumbing.
Exactly. The CEO stated VICR's solution is feeding those IVRs with a current multiplier.
A current multiplier. So
Yeah.
how does that bypass the garden hose problem?
Well, that current multiplier is the core of their second-gen VPD intellectual property. VICR has patented a way to fundamentally change how power is stepped down right at the edge of the processor.
Okay.
Instead of relying on a traditional regulator that struggles with current gain, VICR's architecture allows for high voltage to be delivered extremely close to the processor.
Oh, wow.
Yeah, and then their proprietary tech physically multiplies the current while dropping the voltage in an incredibly dense small footprint. It completely bypasses the traditional heat and space limitations.
So they can deliver higher current density directly to the pins of the GPU without those massive I-squared-R losses that are bottlenecking the first-generation systems.
Exactly. And Dr. Vincerelli is completely unapologetic about this advantage.
Yeah, he stated that Vicor's second-gen VPD IP is uniquely equipped to overcome the power system challenges standing in the way of future TPUs, GPUs, and wafer-scale engines.
And, you do not use phrasing like uniquely equipped in a legally binding financial document unless you have the patented architecture to back it up.
Which brings us full circle to why companies are suddenly paying them $30.4 million a quarter in royalties.
Right. The physics are unforgiving. You can write the most elegant, efficient machine learning code ever conceived.
Sure.
You can design a silicon chip with hundreds of billions of transistors. But if you cannot physically deliver enough clean, massive electrical current to that chip without melting the motherboard,
Or requiring a power plant just to cool the server rack.
exactly, then the entire system stalls. The hyperscalers are hitting a wall dictated by the laws of thermodynamics, not software engineering.
So Vicor is securing a $380 million backlog because they are not selling an incremental software update. They are selling a physical solution to a hard physical limit.
Yep. If you want to unlock the next generation of AI performance, you have to solve the power delivery problem first.
Let's pull all of this together and look at the narrative arc we just walked through today.
Yeah, it's quite a journey from the top-line numbers.
We started with financials that, at first glance, look stagnant. They were heavily masked by a past litigation settlement that skewed the year-over-year comparison.
But once we stripped that away, we uncovered a rapidly scaling operational engine generating massive royalty revenue.
Right, proving their IP is now a mandatory toll booth in the industry. We saw a 145% year-over-year backlog explosion driven by structural demand in high-performance computing.
Which is completely absorbing their first fab's capacity.
We looked at a fortress balance sheet with over $450 million in cash and barely any current liabilities, giving them the strategic sovereignty to build a second fab without relying on expensive debt.
And finally, we decoded the brutal physics of current density and power loss that make Vicor's current multiplier technology so uniquely critical to the massive AI hardware ecosystem.
It really reinforces why reading past the headline numbers is vital. A superficial scan of this earnings report suggests a flat business.
But a deep dive reveals a company positioning itself as the critical gatekeeper for the physical future of artificial intelligence, armed with the balance sheet to manufacture that future on their own terms.
A critical gatekeeper for the future. And that leaves us with a final thought for you to ponder long after this deep dive ends.
Yeah, based on the CEO's stark assessment of the industry's severe power limitations, consider this.
We spend nearly all our time talking about the AI boom in terms of large language models, algorithmic breakthroughs, and parameter counts.
Right, the software side.
But if the future of artificial intelligence isn't ultimately gated by the software code, or even the silicon logic gates themselves,
But by our literal physical ability to deliver raw electricity to those chips.
how much of the current AI revolution is actually just an advanced electrical engineering arms race?